Welcome back, everybody. We are going to continue on with the Federal Retirement Optimization Guide for 2025. This is going to be video 8, or part 8 of the book. Right now, we are in the section on the Thrift Savings Plan, which is part 3 of the book. So we're going to go through the Roth versus traditional decision tree. So this is going to give you some guidance on, do you want to do Roth? Do you want to do traditional? Okay. The goal is to pick the mix that lowers lifetime taxes and Medicare surcharges, not just this year's tax bill. You can split contributions across Roth and traditional. So start here. Is your current marginal tax rate likely lower than you expect at retirement? Think early career, temporarily low income, heavy deduction, gap years before Social Security. If yes, favor Roth. Pay the small tax now, harvest tax-free growth. If you're unsure, next question. Are you in a high bracket today and expect lower retirement? So this is common near peak earnings, plan to retire before Social Security, smooth income later. In that case, you favor traditional. So you defer now, fill lower tax brackets later via withdrawals and conversions. You're still unsure. Next step here is, will Roth TSP help you manage future required minimum distributions? And IRMA, Roth TSP has no lifetime RMDs, fewer taxable withdrawals, can avoid Medicare surcharges. If yes, tilt more towards Roth. If no, next question, cash flow sensitivity. Would paying tax on Roth contributions crimp essential savings? If yes, favor traditional. Keep take home, pay high, don't underfund. No? Next question. Do you expect to retire before 59 and a half and use the TSP rule of 55/50 for penalty-free withdrawals? Yes, either works. Focus on tax rates, steps 1 through 3. Tip, leaving money in TSP preserves the penalty exception. No? Go to the next one. 5-year clock. Is your Roth TSP quote-unquote open for more than 5 years by the time you'll withdraw earnings? If yes, Roth remains attractive. If no, start Roth now, even a small contribution to start the 5-year clock. High earner catch-up rule from 2026. Is the prior year's Social Security wages greater than $145,000? If yes, catch-up must be Roth starting 1/1/2026, so not quite yet, but pretty soon. Plan around added taxable income. If not, then you can choose Roth or traditional for catch-up. All right, simple mixes that work well for many. During your peak earnings years, spend 70 to 100% traditional, remainder Roth. Bridge/gap years, if you're retired, pre-Social Security, 50 to 100% Roth or conversions. Unsure, 50-50 split, and revisit annually. Again, reminder, you should be meeting with a financial advisor. We can help connect you to someone that specializes in helping federal employees. Go visit federalpensionadvisors.com to check that out. All right, conversion note from 2026. In-plan traditional to Roth conversions will be allowed inside TSP, taxable that year. Pay taxes from outside funds if you convert. All right, here's a glide path that you could use for TSP allocation. So this is more about which funds you're putting in. Use this to set a sensible stock bond mix, map it to TSP funds, and pre-decide your rebalancing. You can mimic an L fund or customize. Step A, pick a stock/bond target by life stage. Examples, adjust for risk tolerance, pension size, and other assets. During the accumulation, so more than 20 years to retirement, 80 to 100% stocks, 0 to 20% bonds. If you're in transition, you're 5 to 10 years out, 60 to 80% stocks, 20 to 40% bonds. Retirement early, so you're 55 to 62 kind of age, 50 to 65% stocks, 35 to 50% bonds. Your retirement, 62 to 70, 40 to 60% stocks, 40 to 60% bonds. Retirement later on, 70 plus, you're going to want to lower the stocks, 30 to 50%, 50 to 70% bonds. If an all-in-one L fund fits your stage, it's a fine default. If you customize, keep it simple and rebalance on a schedule. So just keep in mind, this is not personalized advice, but this should just give you an idea. You know, if you're close to retirement, you're 55 to 62, and you're still 100% in stocks, probably time to take a look at that. All right, map targets to TSP funds. Here's an example. So the G, risk-free principle. I'll give that again. Risk-free principle. Government securities, good for near-term spending and ballast. F, fund, broad, U.S. bond index, interest rate, credit risk, diversify stocks. C is the S&P 500, large U.S. S, U.S. completion index, mid-small. I, international developed markets. Here's some example allocations. So if you're in transition, which would be 5 to 10 years out, so let's say you're doing 65% stocks, 35% bonds. So stocks, you could do 40% C, which is the S&P 500, 15% S, so those are kind of more the small ones, and then 10% international. Bonds, you could do 20% G fund, and then 15% the F fund, which is, so that's more, F is broad index fund, G is the risk-free principal government securities. Now retirement, you might go to a 30% C, 10% S, 10% I, and 30% G and 20% F. So that's now you're 50-50 between stocks and bonds. Capital preservation tilt. So now if you're going to do 40% stocks, 60% bonds. So stocks could be 25% C, 7% S, 8% I. And then bonds, 40% G fund, 20% F fund. So obviously you make your decision on where you're going, but this kind of gives you some ideas for where you want to invest. All right, rebalancing and maintenance. Check a schedule. You're going to want to at least annually, but if you want to do it semi-annually or quarterly, makes sense. Rebalance when any fund drifts more than 5% from target. Cash flows. Direct new contributions to the lagging funds to reduce trading. Bucket overlay optional. So bucket 1, a 1 to 2 year withdrawal, 100% G fund. Bucket 2, 3 to 7 years, a mix of G and F funds and some CSI. Corporate, small, and international. And then bucket 3, 8+ years growth, CS and I. So step D, withdrawal alignment. Rule of 55/50 users. Keep enough in TSP to leverage penalty-free withdrawals. Avoid immediate IRA rollovers. Tax lens. Pull from traditional to fill low brackets. From Roth to avoid IRMA or bracket creep. RMD lens. Required minimum distributions. Traditional balances create RMDs at 73. Roth TSP has no lifetime RMDs. Last step here, contribution pacing. Per pay math, make sure it's 26 pay period. So on 23,500, that's 904 per pay period. If you're 50 plus, you've got that catch up. That's an extra 288 per pay period. And then the super catch up, 60 to 63, that's an additional 433. So don't cap early. Ensure contributions continue all year to capture the full match. Before you lock the dial, stress test your Roth and traditional mix and your glide path against realistic tax, Medicare, and market scenarios. Again, meet with an advisor at federalpensionadvisors.com. They will check everything for you, give you a second pair of eyes. Just make sure you're on the right track. Okay, good. In the next video, we're going to go over frequently asked questions for the Thrift Savings Plan, and I will see you there.